Hey everyone, welcome back to Corporate Decoder. Today we're diving deep into Warrior Met Coal's latest 10K filing. Ever wondered what goes on behind the scenes when a major coal company reports its yearly earnings? We're about to find out, and trust me, this report has some juicy details about operations, big investments, and yes, even a sprinkle of that good old corporate excitement you all love. Before we dig in, if you appreciate getting straight insights from these filings, make sure you are subscribed. We also have a Discord community linked in the description below where we break down these documents together. Alright, let's talk Warrior Met Coal, Incorporated. They're a big player in the steelmaking coal world, supplying this essential ingredient to steelmakers across Europe, South America, and Asia. Think of them as a vital link in the chain that makes the steel for everything from cars to buildings. They operate their mines in Alabama and are pretty proud of their high quality, low cost approach. They've also got a natural gas operation, which is kind of like a side hustle, pulling out gas from their coal mines and selling it. They operate as one main business segment and their main product is hard coking coal. Now the company lays out a few key strengths and they're really hammering home the pure play aspect, meaning they are all about steelmaking coal. Unlike some others, they are not dabbling in other types of coal. This focus, they say, allows them to achieve better prices and profit margins. A big part of their story is the Blue Creek mine, which they kicked off operations at in October 2025, apparently 8 months ahead of schedule and right on budget. This is a huge deal for them, boosting their capacity significantly. They also emphasize a flexible cost structure, meaning their costs go up and down with prices designed to keep them profitable even when the market is tough. And get this, they talk about a robust logistics strategy, which basically means they've got a good plan to get their coal to customers overseas, and they think they have a cost advantage there. Let's look at the numbers. Their coal reserves are significant. As of the 31st of December 2025, they estimate about 186.2 million metric tons of recoverable reserves. That is a lot of coal. The quality seems pretty good too, low sulfur and high strength, which is what steelmakers want. The Blue Creek mine alone is a big component of that, with a good portion of the reserves leased and some owned. They break down reserves by mine, and you can see mine number 4, mine number 7, and Blue Creek are the main players here. These numbers represent the coal they confidently believe they can extract and sell. Production-wise, they had a pretty good year in 2025, producing over 9 million metric tons of coal. That is a jump from the previous year, thanks in large part to Blue Creek. Starting up, even though Blue Creek was new, it still produced a significant amount. Sales, however, were a bit lower than production, which is something to keep an eye on. Here is where things get really interesting. The per unit economics for 2025. Their average selling price per metric ton dropped about 29.5% compared to 2024, going from over $207 to around $146. That is a big hit to revenue per ton. But here is the silver lining, their cash cost of sales. Per metric ton also dropped by about 19% from nearly $139 to around $111. This means they made their coal cheaper to dig up and get ready to sell, even though the price they got for it went down. It is a bit of a mixed bag. Their sales volumes did go up by 21%, which helped offset some of the price drop, but not enough to prevent a drop in total revenue. So, more coal sold, but at a significantly lower price. Looking at the overall revenue picture, total revenues for 2025 were about $1.3 billion, down from $1.5 billion in 2024. This drop is mainly because of that lower selling price per ton, even though they sold more coal. The all other revenue, mainly from natural gas, did increase, which is a small positive. Now, let's talk costs. The cost of sales stayed high, but as a percentage of revenue, it went up, accounting for 75% of revenue in 2025 compared to 66% in 2024. This is that classic squeeze costs are going down in absolute terms, but because the price they're selling at is so much lower, those costs eat up a bigger chunk of their sales dollars. They mention this is partly due to more Blue Creek coal in the mix, which is cheaper to produce, but those falling market prices are the real story here. Transportation and royalties are a significant part of their costs, and they saw a slight decrease there as a percentage of sales. All this impacts their bottom line. Net income for 2025 was about $57 million, a big drop from over $250 million in 2024. That is a roughly 77% decrease. Earnings per S-Hair followed suit, down from $4.79 to $1.08. The company attributes this largely to the lower average selling price of steelmaking coal. When it comes to cash, they've definitely seen a reduction. Cash and cash equivalents dropped from nearly $492 million at the end of 2024 to $300 million at the end of 2025. That is a significant decrease of about 39%. This is tied to their investments in the Blue Creek mine and potentially lower cash generation due to lower prices. They did have over $140 million available under their credit facility, which is good, but that dwindling cash balance is something to note. Cash flow from operations also took a hit, down to about $229 million in 2025 from nearly $368 million in 2024. Again, lower prices are the main culprit, but they're still generating positive cash flow from running the mines, which is a major win in this industry. Their investing activities show where a lot of that cash went. They spent over $320 million on property, plant, and equipment in 2025, much of it on developing Blue Creek. Even though Blue Creek's longwall is operational, there is still significant investment needed to finish it. This high capital expenditure is a key reason for their cash reduction. The executive compensation is also interesting. There is mention of amended and restated employment agreements for key execs like Walter J. Scheller. The CEO, these agreements seem to offer some protection if there is a change in control, which is standard but important for retaining top talent, especially in a volatile industry. Now the risks, and believe me, there are a lot. They're heavily exposed to global economic conditions, especially demand for steel, which directly impacts their coal prices. They also highlight competition, particularly from international producers, and any disruptions in transportation like port issues or rail problems can really hurt them. Labour relations are a big one too. With a unionised workforce, there is always the risk of stoppages, which they've experienced. Environmental regulations are a constant concern, as are the costs associated with mine reclamation and black lung benefits. And of course, there is the debt. They have substantial debt, which limits their flexibility and could make it hard to raise more money or even make payments if things go south. Here is a quirky one. They have these 382 transfer restrictions on their stock. It sounds complicated, but basically, it is designed to prevent them from losing out on valuable tax benefits related to their net operating losses. If the ownership of their stock changes too much, they could lose those benefits, which would be a major financial hit. So they've put rules in place to control who can buy their stock, which can make it less attractive for some investors. Looking at liabilities, asset retirement obligations are a big one. They've got about $70 million set aside for reclaiming land after mining is done. This is a standard but significant cost for any mining company, and these estimates can change as regulations evolve or as they dig deeper into the economics of reclamation. Their auditor highlighted this as a critical audit matter because it involves a lot of judgment and assumptions about the future. On the balance sheet, you see wages and employee benefits accrued, about $68 million for 2025. This is typical for a large workforce. What stands out is their commitment to offering competitive benefits and investing in employee training, which they say is crucial for safety and operational success. Scroll Worry or Met Coal Inc. Scroll consolidated balance sheets in thousands. Looking at the actual balance sheet, assets are over $2.7 billion. Current assets like cash and receivables are strong, and their property, plant, and equipment is substantial, reflecting their mines and infrastructure. Liabilities are also considerable, with significant long-term debt and those asset retirement obligations. But what is really interesting is their equity. They have a healthy chunk of retained earnings, showing they've been profitable over time. $56,998, $250,603, $478,629. Let's circle back to the bottom line, net income. The company saw a significant drop in net income for 2025 to about $57 million, down from $250 million in 2024. This is about a 77% decrease. The primary driver, as we noted, is the lower average selling price of their steelmaking coal, which fell by almost 30%. Despite increasing their sales volume by 21%, that price drop was too much to overcome, leading to lower profits. Consolidated statements of cash flows in thousands. Their cash flow from operations provided about $229 million in 2025, which is down from about $368 million in 2024. This drop reflects the lower profits. Their investing activities used over $405 million in cash, mainly for capital expenditures on their mines, especially Blue Creek, and acquiring some new federal coal leases. This investment in future growth is key, but it certainly impacts their current cash reserves. For the year ended the 31st of December 2025, 2024, 2023, sales $1,277,000 and $24 $1 million. $499,980, $1,647,992 cost of sales, exclusive of items shown separately below: $982,401, $1,000,000, $7,297, $910,269. The numbers really tell the story here. Total revenues for 2025 were $1.3 billion, a decrease from $1.5 billion in 2024. This is driven by that lower average selling price per ton. Even though they sold more coal, cost of sales also went down in absolute terms, but as a percentage of revenue, they increased, squeezing their margins. So, what is the takeaway? Warrior Met Coal is in a tough spot, but they're managing. The big investment in Blue Creek is a strategic move for long-term growth, but it is costing them cash in the short term. Lower coal prices are impacting their profitability significantly, but their focus on cost control and operational efficiency is helping them weather the storm. They're still generating positive cash flow from operations, which is a major strength. The risks are substantial, tied to global demand and commodity prices, but their core business, steelmaking coal, remains essential. Alright, that is our breakdown of Warrior Met Coal's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.